Let's get to Tapan Datta, Head of Global Asset Allocation at Aon. Tapan, nice to have you back. I was fascinated reading some of your commentary around US yields. We know it's the number one issue for a lot of fund managers at this point, but you also give us a sense that if you see this very quick move in yields in the States, it could be self-limiting. Just unpick that for us.
Well, the reason I say that is because the faster yields rise, the more likely it is that markets or risk markets run into heavy weather. So that is the most important consideration that makes it kind of self-limiting, because as we know, the Federal Reserve particularly is very sensitive to what it calls financial conditions. And risk asset pricing is a key component. So in general, the issue here is that if yields carry on rising at the pace they've been doing, the Fed will very likely have to step in. So that in itself makes it self-limiting. But fundamentally, there's also a kind of limit appearing, because the kind of pricing that the bond markets are doing in terms of likely inflation and potentially the path of Federal Reserve interest rates is also now threatening to outrun the fundamentals. So even fundamentally, there is a risk that this rise in yields becomes quite quickly self-limiting. Now, we're probably not at the time where those limits are definitely on us. And one of the reasons why I say that is because the market really wants to see, is really testing what the Fed's tolerance limits are in terms of how far and how quickly yields will rise. And it hasn't seen the Fed display those limits yet. So it's waiting to see that. But I think the time is coming when those limits will quickly appear. And at that time, what you will see is potentially quite a large move downwards in yields as that reset occurs. But we're probably going to see yields higher before that happens.